Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me as he does each and every week from a bunker in South America, it is Green Zone Fortunes coder Charles Sizemore. We are back for another episode of Investing with Charles. Today, we are going to talk about the difference between blue chip stocks, index funds, all these things that you can think about when you're trying to put into your retirement. First, I'd be remiss if I didn't tell you to check out moneyandmarkets.com. It is your home for safe, sound, smart, simple, profitable investment information. You can use our proprietary stock power rating system on the website. Just when you're on the homepage, there's a search bar up in the top right-hand corner of the homepage. Type in any stock ticker, any company name, and you can pull down our proprietary rating. It's broken down on 6 factors, 3 fundamental, 3 technical. You'll see a price stock chart rather, some fundamental data, any analysis that we've had on that particular stock. It's all right there at your fingertips for free at moneyandmarkets.com. Now, like I said, we're going to talk about, blue chip stocks, retirement accounts, and index funds, which is a great, right in the wheelhouse of Charles. And our question actually, we actually had a question from outside. Joan emailed us and she said, I'm decades away from retirement. Should I be buying blue chip stocks in my retirement account now while they're cheap? Or is it best to stick with safe indexed funds? So there's your question, Charles. Take it away.
The answer is yes, all of the above. No, so, okay, that actually is a really good question. And I'll start with index funds. So if index funds are what you have access to, then that's probably fine. At the end of the day, index funds give you a nice sampling of the best of America, America's best and biggest companies. That is, if you have either limited capital to invest, or you're talking about your 401k or whatever, and you just have a menu of mutual funds and that's just what you have access to, then buying an index fund and being done is fine. Now, today, prices are a little on the high side still, even after some of this, after this kind of correction / bear market we've had this year. Prices are lower than they were at the beginning of the year, but they're not, this isn't necessarily a fat pitch moment for index funds. But at the end of the day, if your time horizon here is years in the future, then there's absolutely nothing wrong with buying index funds. However, there's always a however. I do lean towards picking out a portfolio of individual blue chip names, and there's a couple of reasons for that. And at the top, I'll say, look, index funds are good, but they do have one structural problem, and that is most index funds tend to be cap weighted. What that means in plain English is that they weight the holdings of stocks by their size. So the biggest, most valuable companies are the biggest component of the fund. They're not weighted by profitability. They're not weighted by prospective value in the future. They're weighted by their value today. That might sound logical, and certainly there is logic to that. It's if you're just wanting a slice of the stock market, that's not an illogical way to do it. The problem is there's always churn at the top. And so when you're buying a collection of stocks, when you're buying an index fund, you're buying it heavily weighted towards those top names. You're buying that collection of stocks that's already really done well in the past. Like the value today, the biggest stocks in the S&P 500 are all worth over $1 trillion. You're buying stocks that are already gotten there. And sure, they can continue to grow, that's fine, but their best years of growth are behind them. You're buying them when they're already mature. So, when you find this great, there are going to be towards the bottom of the S&P 500, there's going to be those up and comer names too, but you're not really getting big access to them. You're getting a very tiny, small fractional amount. So kind of the biggest drawback to just buying an index fund and being done is you're kind of getting stuff when it's already had its run, right? But then beyond that, an index fund is exactly what it's designed to be. You're getting the market. So you're getting the good and you're getting the garbage. You're getting a little bit of everything, right? So why settle for that? Why settle for the good and the bad when you can just cherry pick and come up with a list of really solid blue chips that you think should outperform the market?
So let's dive into that a little bit more, because you mentioned index funds, they are safe, and Joan accurately put that on there. They are relatively safe, but
over a long enough time horizon, they can drop 50% in value in a given year. Who knows, right? But over a long enough time horizon, you should make money in an index fund.
However, if you're looking to make more, if you're looking to bolster your retirement account even more, then you, as you say, want to cherry pick. So let's talk about some of those higher end stocks that would be heavily weighted in an index fund.
Yeah, sure. So, looking at those top holdings, the ones that tend to make up the weight of the index fund there, the top two right now are Apple and Microsoft. And these honestly are great companies. Who wouldn't want to own Apple? Who wouldn't want to own Microsoft? They're fantastic blue chip stocks, and both rate bullishly on our stock power rating system. Both rate over a 60. That's solid. But when you get down to the next couple, it's really not as attractive of a story. The next several in a row are all either neutral or actually bearish in a few cases. So, I'll give an example. Amazon.com, which is one of the best, success stories in the last 50 years of American history. Our model suggests this isn't really the best time to be backing up the truck and buying that. It rates bearishly right now. So if you're buying an index fund, you're buying a lot of Amazon. Our model suggests you should probably wait on that.
Meta would be another one. Facebook. This is another one kind of in that same vein. It, a great story leading up to, even about 5 years ago. But now stock power rating system, it has as a 36, which is an avoidance for us. We say, no, this is not the time. Great quality stock. It's got great quality market.
It means money. It's a profitable business, but
its momentum is weak.
The time.
Yeah, our price-based metrics are very, very poor here. We've got very high volatility. We've got very low momentum. It's obviously a bigger company, as we've talked about before. Bigger companies are great, but they don't generate those portfolio eye-popping profits that you like to see, that everyone wants in their portfolio. And then Netflix, this would be another one, 38 on our stock power rating system. Again, great growth, solid quality, decent value, but price-wise right now, very bad momentum. It's big. Its volatility is very high. So that'll be another kind of in that chain of it's a great big stock, but now is maybe not necessarily the time to get into it if you're looking at adding for your retirement.
No, exactly. So when you're putting together that portfolio, whether it's if your 401k allows you to pick individual stocks, some do, some don't, but in your IRA, your Roth IRA, you have the ability to cherry pick. You can even, if you're the adventurous sort, you could start with the entire list of the S&P 500 if you wanted, and just remove stocks that really didn't make the grade for the time being and focus on the ones that do. I mean, that's a lot of homework, of course, but that's, if you are looking for that portfolio that should do well in the here and now and beyond, then cherry picking the best of the best makes sense.
And you actually have your eye on one that isn't necessarily a massive company, but one of those that could yield some very nice results for a portfolio.
I do. Earlier this week, I actually recommended Energy Transfer in a piece I wrote for Money and Markets. This is really, this is why you're never going to get this in an index fund, or if you do, it's going to be such a small holding in the index fund that its movement isn't going to really be noticeable. It's one of the largest pipeline companies in the world. They operate about 120,000 miles worth of oil and gas pipelines. Rates about an 85 on our stock power rating system, and it rates solidly across virtually every metric but size. Size, it's a little bit too big to rate well on that metric, but hey, 5 out of 6 ain't bad, right? So we'll take it. It also yields it has a fat dividend yield of almost 7%. So this is a stock that's been doing phenomenally well in 2022, a year in which the market in general has been in the toilet. This stock is up about 40% on the year, not including that fat dividend. So this to me seems like if you're going to weight your portfolio towards something, weight it towards what's working right now. And this is what's working right now.
So the message here for Joan, and Joan, by the way, thank you for asking that question, is, index funds are fine, but if you're really wanting to expand that retirement portfolio, it's best to kind of pick and choose, not necessarily just stick with an index fund or something like that. They'll do okay, but if you really want to do even better than okay, which I think we all do, then it's best to find those individual stocks, as Charles says, that are working right now. Yeah, did I encapsulate that right?
You did indeed.
And if you do want to learn more about Energy Transfer, then we are going to have that story is going to be up on our website, moneymarkets.com. Just you'll be able to find it. Should be right there on the homepage. If not, you can search out Charles's name and find it. He's got an in-depth look at ET, which is the ticker symbol for that company. And you can find out a lot more about it. Charles, thank you for taking the time to answer the question. Great question, Joan. Next week, we are going to talk about, since we're kind of on the heels of this, of talking about a company that has a very, very healthy dividend yield. We're going to kind of dive into that a little bit more and talk more about dividend yield and maybe even pinpoint some stocks that have great yield that could be even better for your portfolio. So, Charles, any parting shots?
No, I think that pretty well sums it up. Yeah, we had a really rough patch in the market there. April and most of May were awful, but we may get lucky here and we may enjoy a nice little rally over the next few weeks. My advice is don't try to call a bottom in some of the stocks that have been dogs lately. Instead, use this as an opportunity to buy what's been working, because that should continue to work for at least the next few weeks, if not months, if not the rest of the year.
Very good. Again, next week, we're going to talk more about dividend yield. If you do have a question about a dividend yield, maybe what it is, or maybe you want to talk about a particular stock that you think has a great dividend yield and what that means for your portfolio, submit that question to us at feedback@moneymarkets.com. Just email us. Very easy to do. Feedback@moneymarkets.com, or you can drop a question down below here on our YouTube channel. We would love to see what you have to say. He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I am Matt Clark. I'm the research analyst for Money and Markets. Until next time, everyone, safe trading.